All right. First of all, thank you so much for joining us. And I'll also give you guys the credit, especially for the out-of-towners. This is basically the original group of VCs that we had asked to show up in person. So, you know, for the most part, all of these VCs were willing to take a trip in and come and see us in person, and are, you know, have either done investments in New York, actively scouting in New York, and, you know, to the extent that, you know, VCs are, you know, open for business in this new normal, they are, you know, active investors during this period. So I do want to ask a little bit about that. And, you know, I feel like things change a lot week to week. You know, we're sort of all about a month or so, depending on where you are geographically, into this quarantine. And we've heard various things about like who's open for business, who's investing, and all that. And I just want to take a chance. If each of the panelists could sort of introduce themselves and their firms, but just give me like a one-sentence snapshot of like, where are you guys now as a firm in terms of, are you still mostly focused on internal portfolio? Have you taken new pitches yet? Andrew, why don't you start us off?
Great. Can you hear me, Charlie?
Yes.
Great. Yeah, it's a good question. So we're definitely open for business. In fact, I looked back. I've been asked this question several times.
And who are you? And what is your firm?
Yeah. Okay. Great. So I'm Andrew Cleland. I'm a partner with Comcast Ventures. I've been with Comcast Ventures for about 9.5 years now. And before that, I was a partner at Time Warner Investments, focused mainly on enterprise software and data-related investments. So Comcast Ventures has been has very much been open for business. I look back over the last 3 weeks or so, we've closed 6 deals in that time. So actually more active than usual. The difference for us is that a lot of those deals were already in process before the crisis hit. So it was very important for us reputationally that we didn't back out of any processes that we were already in. We have an institutional memory. We know that others have institutional memories. We didn't want to renege on anything. We wanted to make sure that we stood behind the handshake deals that we had. The difference for us is, I think with the new normal, there's this incredible period of uncertainty. So we are just as active as we've always been. We are taking new deals. We are taking second meetings. The question for us that we haven't come to full resolution on is, can we commit to a larger size check without ever having been in the same room as the entrepreneur? That's a difficult one for us. And I think there are different views around the table, and I think the answer changes depending upon the size of the check. So I think we could get comfortable writing smaller checks under those circumstances, probably less comfortable writing larger checks.
And just realistically though, I mean, we're only sort of a month into this quarantine. The deals that you were just closing probably were going to take longer than a month anyway, from like first meeting to founder to actual check cashed, right? So it's not surprising that there aren't many deals that started and ended during this quarantine, because that would be pretty quick under any normal circumstances.
Yeah, that's absolutely right. I think the difference is conversations that we've started since the crisis, we don't know when they're going to end. And I think there is a variety of different opinions on that. I personally would say I could get comfortable writing a seed stage check under these circumstances. I think the process needs to be a little bit different, but I personally would be uncomfortable, say, writing an $8 million check without ever having broken bread with the entrepreneur, let's say.
Gotcha. Nikhil, do you feel somewhat in the same boat? And if you could also do the firm intro, that'd be great.
Yeah, for sure. Hey everyone, I'm Nikhil at Shasta Ventures, early stage focused firm based here in San Francisco. And I think we think very similarly to what Andrew said. We've made one new investment since shelter in place, so in the last month. But that conversation had started before the pandemic was declared. And the honest truth is, when new investments were maybe priority number one or priority number two before the pandemic, new investments have become priority number four. Portfolio companies have become priority number one. Stuff inside the firm, communicating with our LPs, priority number two, and new investments, down the stack. In the middle of all that is, of course, all of us thinking about our own health and the health of our founders and the employees at our portfolio companies. So the prioritization stack rank has just changed.
Sure. Monica?
Yeah, so I'm at Kleiner Perkins.
I actually thought you were outside there for a moment. That was really,
yeah, I'm a big fan of the virtual background. So yes, I'm at Kleiner Perkins. I've been here for the past year and a half. The firm is focused on early stage, kind of Series A with a bit of seed and a bit of Series B. And I'm focused on fintech and consumer personally. We have also made kind of 2 investments. So we closed our most recent fund March 5th, so right at the beginning of this. And so we've made 2 investments out of that so far. Both to that point have been from, processes that began prior. So we're now starting to see our first companies come through the partnership that are, really the whole process has been run through this. I think there is hesitation around this like online version, but I think it's also just trying to understand, what the short and long-term effects of quarantine, and not just quarantine, but what is happening in the world right now are, both in terms of there being, economic impact, and then also just this is a huge shift in the way people work, a shift in how healthcare is delivered, everything. So we're trying to wrap our heads around that, and definitely to Nikhil's point, there is a ton of, and I think this is really what marked the first month, was a ton of efforts with portfolio companies, internal LPs, all of that, to try to make sure that everything was sorted there before we could even begin to take these calls now.
Angus, would you agree that the idea, I'm getting the sense that the last month has been more sort of inward focus. Is most of that work internally in your firm? I mean, obviously you're always still monitoring and changing situations, but would you feel like of the bulk of that work, at least figuring out what the plan is for each portfolio company, whatever, is mostly behind you as a focus of the firm? And firm intro as well.
Sure. Quickly, and I'll put up my contact information. Anyone wants to contact us. I've got the virtual background. I'm in the office today, if you haven't figured that out. No, I think that's right. I think especially for our portfolio companies that were going through really acute challenges, some of that stuff is behind us. So, large layoffs or things like this for firms that might have been for companies that might have been especially exposed to the, for example, travel space as one example. That said, I think, as Monica was alluding to, there still remains a lot of uncertainty around what other sectors that are less obvious, how they will be affected, how deeply, and for how long. So I think that to a certain extent that inward focus remains. The pace of communication with our management teams across the portfolio has certainly picked up.
Monica, you alluded a little bit to trying to figure out, what the sort of new normal would be like, and how portfolio companies were going to have to deal with this. So it's not just quarantine, but it's the environment sort of coming out of that. Do you have a sense of at least what the firm and your founders' sort of median expectations are for like a back to work kind of period, at least something approaching normalcy, that when you are closing these past couple of investments are sort of baked into the assumptions?
Yeah, I mean, I think Angus's point is totally right, which is it's constantly changing. I mean, this has been a period of like rapid change in that sense. I think internally, we have companies that are across the gamut of, potentially seeing tailwinds off of this with a lot of remote work and things and telehealth and all that. A lot of companies where this is somewhat of a pause situation, especially if you're selling into enterprises, and then companies where, you know, there's potentially bigger disruptions. I think on the back to work side, you know, it's anyone's guess. I think we're hopeful that you'll start to see some kind of, you know, green, yellow, red type scenario, and basically like soft openings of regions and for specific type of workers. I don't know that I have an expectation that like I, as someone who can work from home, will be going into the office every day. And I think the team would maybe try to come back together so that we could, you know, meet some of these founders in person and such, but in specific moments, not for the whole week. So I think it's kind of, we imagine there will be a gray period for a while, and that will probably be part of setting more norms. You know, if this quarantine was just a month and then it ended, you wouldn't see as much of a behavior shift. But if people are working from home multiple days a week for the next year or so, like you could see some real shifts happen.
Nikhil, do you think this is going to change how you interact with founders sort of going forward, that your return to work is going to look different than it did before? Are you maybe, like the rest of us, sort of a little more comfortable on video than you might have been before? Or do you think that, you know, whenever we get the CDC green light, like your work style is the same now?
You know, I think we're all adjusting and feeling more comfortable. At least I'm feeling more comfortable every week, you know, in this new normal of Zoom. But I think it kind of depends on the investor. You know, there's in my experience, there's sort of, you know, there's three different things that most investors hang their hat on in the investment decision, right? One is the market. Another is the product, or maybe the early signs of product market fit. And then the third is the founder and the team. And for investors who are in that final bucket where, you know, the investment decision sort of begins and ends with a thesis around the founder and a thesis around the team, it's just harder to make those investments without spending time in person with the founders. I'll pick on Angus because Angus was the founder and CEO of a company called Swipely, which renamed to Upserve. But Shasta led the Series B of Angus's company. And in 2013, my partner Sean and I went out to Rhode Island and spent a day with Angus and his team. And we would, the sort of thesis around the Series B investment in Upserve began and ended with Angus. I think it would be very difficult for us to have made that investment had we not visited the team, spent a significant amount of time with Angus to get conviction in his hunger, drive, and passion as a founder.
Gotcha.
That's very kind and generous of you to say, Nikhil.
Andrew, you touched upon being comfortable making, you know, potentially smaller bets. Do you think that may be a shift in this period where, you know, you like a company, you and your team gets as comfortable as you can, having not met them, and instead of maybe leading an A, that you say, well, you know what, like this is sort of a weird period. Let's look at the next 6 to 9 months together or something like that. Let's maybe come together and bridge you and de-risk both sides of this equation, because, you know, we want to get involved in your company, but a little weird for us to be writing an $8 million check.
Yeah, I think, you know, chiming upon some of the things the other panelists have said, I think there's 3 phases. One is the oncoming chaos of the pandemic hitting and everybody trying to sort through their portfolio and help the portfolio figure out the right go forward steps. The next one is complete uncertainty, both health uncertainty and economy uncertainty. And I think that's where we are at the moment. And then the third one is the new normal. We kind of figure out some of the uncertainty and we adapt to whatever the new normal is. And I still think we're in maybe even the beginning stages, or certainly the middle stages of uncertainty. And hopefully in 4 weeks' time, we certainly won't be through this, but the uncertainty will have degraded a fair amount. I think all have started to wrap our arms around what a recovery program or a back to work program might begin to look like in 4 weeks' time. And then I think at that point, we could have a much better answer for your question, which is, okay, we understand how business is going to stand back up again. We understand the risks. We understand, therefore, we have a point of view on what the new normal looks like, and we can operate in those circumstances. I think what is very challenging is operating within where we are now, which is very high uncertainty. And I think that's true both for the entrepreneurs and for the providers of capital. It just probably doesn't make sense for either side to do too much in this, month and a half to go, just extremely high volatility. So our counsel to most companies has been, sit tight, preserve capital. The earliest you should probably be picking up conversations again in real earnest, as in actually receiving checks, is 4 to 6 weeks, because by that time we think at least we'll have begun to figure out what the new normal starts to look like. And I think once that uncertainty goes down, business can flow again. I just think this period, this fairly narrow period, is so uncertain, it's difficult to write a big check. I think the exception to that is, I think pre-seed companies that aren't going to be generating any meaningful revenue for 8 months anyway probably don't look that much different, and you could get comfortable writing that kind of a check.
Right, because especially if you were, let's say, a first-time founder or didn't necessarily have a long background or something like that, there's not normally a lot of data in that kind of an investment anyway. You like the space, you get a sense of the founder, but so I could see how that maybe isn't that different, although the getting to know you period is a little bit different as well.
Yeah.
Let's talk just sort of practicality right now, right? So I've noticed, and I don't know about you, I've seen pitch volume fall off the table, right? And just in terms of the amount of inbound of new companies getting started seems to have gone down in the last month. And I think the perception is, well, this is a terrible time to fundraise. If, I might as well tinker with my deck for another couple of weeks, at least until, maybe the public markets come back a little, or I give VCs a time to breathe. But I do have this reality of, like, I need money, and I can't push this off forever. And I didn't have employees prior, so it's not like there's any payroll protection coming my way. So I have to start this process at some point. Is it a waste of time now for an entrepreneur to reach out? I mean, Angus, you put up your little, news person, screen bottom there and seem to be welcoming. And while I appreciate that, is that just a red herring? I mean, like, should I really be starting a relationship with you now? Or should I at least, wait a month until you feel a little less stressed or what have you?
I mean, look, I've spent the last 20 years as an operator, as a founder, and only, officially became a professional venture capitalist when I became a partner of Foundation in September of last year, right? So my Patagonia vest has, my Patagonia vest hasn't been issued yet, and I haven't learned the secret handshake. But I frankly have been really surprised by the way many of my peers in venture capital in Silicon Valley have reacted to this crisis, having frankly lived as an operator through 2000, 2008, 2001, which frankly the 2008, the GFC in my view was a much scarier situation, at least from a financial market standpoint, than the situation today. And my point of view is most of my venture capital peers fall into what I see as sort of two camps. Camp one is, tell every company, regardless of their situation, to cut spend, put all deals on pause, relocate family to Lake Tahoe for the apocalypse, and buy Bitcoin. And then sort of camp two is,
I don't think that Bitcoin thing really worked out.
Yeah, thus far it's pretty highly correlated with risk assets, but we'll see. And then the second category would be kind of figure out how to work maybe 25 hours a day to buy stakes in good companies while the competition in camp one is distracted. Unclear if we get a meaningful price, term, or opening advantage, and what that quantum looks like. Is it a 20, 30, 50% distinction or what have you? But work hard looking for those great investment opportunities. Now, personally, and again, maybe I haven't been a VC long enough, but I'm in camp two. My point of view is there's a lot of Silicon Valley in camp one. If you look back at things like, for example, the financial crisis in 2008, and everybody likes to refer to Sequoia's RIP Good Times presentation. Following that presentation was one of the all-time first of all, that was one of the all-time greatest times to invest. And while Sequoia was saying scary things in the presentation, they were accelerating investments in companies like Airbnb and WhatsApp. And what followed in sort of 2000 and in 2009, there were about 4,300 venture deals done, and that number went up by about 1,000 a year for the next 6 years straight. So, yes, there's a lot of uncertainty, but we've got a 10+ year fund cycle. I've heard in the LP community, somebody from Kauffman Foundation, she describes some funds she's in as being old enough to vote, old enough to drive, and old enough to drink. When you're investing in an asset class that has that kind of duration, I'm not going to be as focused on whether the S&P is at 2,200 or 3,000 this week.
Yeah, exactly. We'll see. We'll see week to week. So in terms of the actual, sort of pitch process and kind of reaching out, what are some, or have any of you witnessed a sort of best practice around approach? We talk a little bit about building relationships and getting to know you, and I would guess that a lot of the founders who actually need to fundraise are sending notes that tiptoe into the category of fundraising, or just hey, would love to talk to you about our company for a future fundraise, but the reality is they probably need money now, but they don't want to say it. Have you guys taken any meetings even in the past week or so, had any outreach where you'd say like, this feels appropriate for the time? Or we're not sure what's appropriate yet. Andrew, anything come to mind?
Yeah, let me answer the question a slightly different way. It's interesting, the premise doesn't match perfectly with my experience. My
Okay.
experience is actually the founder community has a decent bunch of inertia around it and are still talking about deals in the same terms that existed before the crisis in the main. If we look at the recent Y Combinator class, most of those companies came out with $50 million pre's, despite having presented virtually. And I think that kind of attitude has carried over a little bit. Not many of the entrepreneurs that have pitched to us have openly acknowledged the situation and said, look, it's different times. I expect a different kind of conversation. What we have noticed is we have noticed more persistence from entrepreneurs. So if we politely pass, they might circle back to us and say, well, what if terms shifted, for example, which signals some flexibility on the side of the entrepreneurs that I think is good. I think entrepreneurs should be flexible at the moment. But we haven't
I like that you called that flexibility, and that I think a lot of founders are worried that something like that comes off as weakness. That like, I'm going to try and raise 3 million, but the reality is if I have to make it work with 750K, I'll do it. But I don't want to signal that I can't raise 3 million.
Yeah, I think what we normally advise entrepreneurs in any case is probably don't stick a headline valuation figure out there. Just put an objective for amount of capital raised and see where you get a good conversation going with maybe a range of investors, and see what valuation emerges from that. I think it is a tactical error to say, you know, we're raising 3 on 8 and are you in? Because it can cause you to come back and renegotiate that valuation, which can be a bad signal. But I think flexibility is valuable. But we haven't seen a ton of, you know, the world is different. I'm not sure if we should even be talking to each other. Why don't we have a virtual coffee together and see if we, you know, like each other, and if you understand my business, and we can take it from there some point down the line. It hasn't been that set of conversations yet. It's been a lot of inertia and a lot of conversations that we'd have expected to have pre-crisis. And I expect that to change over the next month or so, just as this inertia kind of moves away. But that's been my experience to date.
You know, Monica, you talked a little bit about sort of trends and things to be sort of looking out for. Do you think there's a possibility that as founders pitch, you know, you alluded to it and I have this too, where there are some companies that have actually in a bizarre way benefited from this? Do you think there's a problem with overcompensating or strategy shift because of this, where people sort of feel like, okay, now, you know, whereas previously we thought that, you know, our plan was to be 10% direct sales, now we're just totally shifting the other way to be opportunistic here, and you know, is that you know, wide pendulum swing possibly a negative in any way?
Yeah, I mean, just as we've seen like tremendous change in the last month, we don't really know how long this will go for. So I think there are some things where you know, people are saying you're seeing the future happen faster. So things like remote work, where, you know, we've had a thesis about this for a while, and maybe now we'll see some of those things happen even faster, like to your point of comfort with Zoom and video in general. But I do think that we don't really know what will happen with a reopen. And so shifting your strategy, if you're later in your plan, your strategy around business model, go to market, product, I don't know that I would make huge shifts. If you're in the very early stages and you have resources and you see a pull one way now, like then maybe pull that thread a little bit. But we're definitely not advising, you know, large shifts in business model yet, given that there are a lot of unknowns in both directions currently. So yeah, I think it's a little bit soon to make that adjustment.
Well, Nikhil, you mentioned, you know, talking to your LPs, and, you know, that's a part of the market that a lot of founders don't really think about much. Like, we assume the VCs are the ones with the money. The fact that you get the money from somebody else is just sort of this, you know, person behind the curtain kind of thing. Do you think there's anything going on in the LP market that may shift how VCs behave, or even just internal fund dynamics? I mean, you probably have companies that you would earmark a certain amount of reserve that now may need more money than you thought. So do you think on the margin, maybe the bar is just a little higher because you had existing companies that are going to take up some of that money that maybe was supposed to go to a new company?
Yeah, so 2 separate questions there. Let me tackle the reserves part first, which is, I think the short answer is yes. I mean, I think, you know, we have shifted a number of reserves over the last month and a half because there are a few companies that have been heavily negatively impacted by COVID-19 in this crisis. And we had to make a few decisions quickly around, are we going to support those companies quickly? And the way that we, you know, typically manage reserves is we look at it pretty frequently. There aren't dramatic changes. Typically, we have a sense for when the next, you know, one company is going to go raise the next round and roughly what that reserve amount is going to be. But those models, just like everyone's financial models probably in this room, changed a lot in the last 6 weeks, and that has just naturally led to more uncertainty around new investing. On the LP side, so venture firms typically get their money from, university endowments, pension funds, fund of funds, family offices. Those are sort of the big groups. Shasta's LPs are mostly in the university endowment, pension fund and fund of funds world. And again, different LPs are impacted differently, but everyone is feeling the same uncertainty we're all feeling right now. The last 10 years has been kind of a record number of funds raised, a record amount of capital coming into the ecosystem for a long time since the 2000 era, and steadily increasing. We've seen more funds come back quickly for their next fundraise, and fund cycles sort of new investing shortened to sometimes even 2 years or 1.5 years. I'm not looking at you, Monica, but and so, I think the general guidance from our LP community has been, it is going to be very difficult for us to re-up to you in a year and a half. Like, this is the time to think about pacing more than ever. They've been encouraging us to think about this for a long time, but they're encouraging us, more strongly than ever, because they don't know, how their allocations are going to shift as a result of this. If an LP has a huge public portfolio and that public portfolio has been marked down heavily in the last month and a half, suddenly the private portfolio, which takes a much longer time to be marked down, just given the nature of private valuations, looks a lot bigger for the LP. And so that's one effect called the denominator effect that impacts LP's ability to commit to private capital.
Gotcha. One quick question before I turn it over to the audience. If anybody in the audience has a question, you could use the little raise hand feature, which so now that we're all Zoom experts, we've had some familiarity with. Advice to current companies. A lot of companies have sort of made some cuts. I think VC's focus was on companies that are sort of in an immediate need. I was talking to a founder the other day, and they were saying that there are companies sort of in the middle that they feel are a little less of a priority. Somebody with, for example, 6 months worth of money in the bank, right? So not in immediate danger of going out of business, but at the same time, may need to start looking at a fundraising, lots of uncertainty as to how long that cycle is going to take, but otherwise, like, maybe performing pretty well. And so they're a little worried about, am I better off giving myself a longer runway or coming into my VC pitch in September with growth? Because usually cutting heads means slowing growth. And any sort of initial impressions of, if you were, Angus, as a, former founder, if I had an otherwise good story and was planning a later in the year fundraising, should I be maybe taking my foot off the gas just to preserve capital at the expense of growth?
Well, 2 recent financings where I signed the term sheet in the last week, actually, were in a characteristic a little bit like what you described. One was a financing for about sort of in the 10 to 12 million range, and the other was a kind of call it $3 million range. And in both cases, the companies were obviously at quite different stages of their growth, but both companies anticipated doing a significant next fundraise, call it over the summer or early fall. And both companies are doing well. And it was clear, though, to both founders that the world had changed and that their ability to get that next big round done in the time frame that they had planned on was probably in some peril. And so what that created, what both founders decided to do is basically do a round that they hadn't been planning on, that was different than what they'd expected. In the smaller check size example I gave, it was a seed stage, somewhere between a seed and an A stage company that had previously raised, call it 3 to 4 million. And as a result of the situation, and had planned to raise their A round in the summer. And as a result of the situation, they were open to taking on an additional 2 to 3 million of cash on the balance sheet. Now look, you're going to experience some dilution as a result of that. But you're also going to get to live to fight another day. And most of us on this Zoom meeting are involved in companies that essentially are going to have sort of a binary outcome. And so in the grand scheme of things, if it's a big success, that small amount of additional dilution isn't going to kill you. In the larger one, it was a company that was later stage, had raised a Series B and basically decided to grow the size of the Series B. And as an investor, I loved the opportunity because that Series B company is spending, both by the way are New York companies, and the Series B company has seen, they're in the consumer space, and CPMs have gone down by 50%. So they're hitting their growth targets. Their customer segment has not been significantly affected, and yet their cost of acquiring new customers is down by nearly half because the competition isn't spending the money. So that's a long-winded answer, but based on some very recent experience with New York companies, I think both founders were wise to extend the runway. Because if you've got 6 months of cash, you're kind of, that's not a lot.
Right, and that's sort of interesting, and potentially difficult timing at that period of time. If you can, pushing a next raise to 2021 probably seems ideal.
And yeah, and the thing that Andrew alluded to earlier, like the YC example was a great one that he shared, because they didn't even present remotely. They kind of put out like one-page PDFs on the company and so on. And then I think there was some surprise that maybe investors didn't react as positively, and so on. Demonstrating flexibility as a founder in the quantum of the fundraise, the terms, and so on. Your job is to keep fighting for another day. You know what I mean? So this is we always advise founders, like, don't go out and say, I want to raise some big number. Start with a smaller number and let the market pull you up, for example. That's long been good advice when fundraising, but even more so in these types of times.
Gotcha. Do we have any audience questions before we jump into breakouts? Use the little hand raise feature if you have one. All right. So thank you so much for participating. I'll leave a couple of minutes so we can transition over into the breakouts. Oh, actually, you know what? We have a question from, oh, you know what? I just lost them. Where did they go?
It's from Yuri.
Oh, Yuri. Yuri, jump in with your question.
Hi, folks. Thanks for the opportunity, and thank you so much for talking. Yeah, wanted to double check with you on sort of like growing in the times of uncertainty. We are kind of like a far pre-revenue project. We're building a new browser, which is why I already sent a quick request to Angus. He built a browser back in the day, so it would be nice to chat. And we have we're super scrappy. I've been approaching 2019 as it's wartime because we expected a correction in 2020. And so as a company, we've been prepared for this in a way, but I'm curious, our current runway is to the tune of, if we stay as scrappy as we are, about 3 to 4 years. I'm wondering if it's a good idea to start finding a partner in these times to double down on the growth instead of cutting back, because I think there might be talent coming out to market in the next 6 to 12 months that's otherwise will never be, like, it's a once a decade, maybe once a 2-decade, 3-decade opportunity to build instead of cut back. And so I'm curious, is that a valid mindset to have, or do I need to be actually a little bit more careful and the situation is worse than I'm thinking about it?
Yeah, just one quick comment I'll make about that. I've heard people talk about the recruiting environment, and while demand for talent in a world where people are cutting back is probably a little bit less, demand for top talent, I think, is always there, and people's willingness to switch jobs may be down, right? So in a really tight talent environment, you may feel more willing to switch because you know your old company will always hire you back if it doesn't work out, or there'll be somewhere else to go. But I wonder on the margin whether or not it might be harder to get people to leave after being 2 years vested at a good company versus just hanging out and invest another year versus taking their chance on a new or earlier stage company.
I'll give 2 quick comments. Charlie, I completely agree with you. I do also think, though, that there will be, almost uniquely in recent history, a set of really top talent that is available on the market because their company was unlucky enough not to make it, or heavy cuts had to be inflicted. So I think it is an interesting time to recruit. Yuri, this is just one data point, but our kind of rule of thumb to our portfolio is see if you can get to at least 18 months runway. And so if you see opportunities to accelerate and pick up top talent that you think could be really contributive for the business, if you pulled in that runway to 24 months, let's say, and I was one of your investors, I'd be completely comfortable. 3 or 4 years is an extremely conservative amount of capital. I appreciate the mentality that you brought to it, and it's worked perfectly given what's happened. But I would say, as has been consistent with our advice for all of our portfolio companies, see if you can get to 18 months runway through pulling a variety of different levers. And that might be revenue levers, it might be repricing levers, it might be sweating the working capital cycle, it might be firing unprofitable customers, and lastly, it may be cutting costs, including people. But you have this whole range of levers in front of you. See if you can get to 18 months, because 18 months is a kind of rule of thumb for, at least we'll understand what the new normal is by then, and capital will be flowing. It might not be at the terms that we've seen 3 months ago, but business will be happening.
Cool. Thanks so much.